Welcome to the Tricord Advisors podcast, where we answer life's hard questions to help you make smart decisions with your money. I'm Jeremiah Lee, and this is Randy Barkley. We're both certified financial planners. I'm also a California licensed attorney. We're going through a series in the next few weeks on financial planning and all the different aspects of financial planning that we deal with on a regular basis. And today we're talking about tax planning. And
part of this is so much fun.
Yeah,
tax planning is like watching paint dry.
Paint dry. People just threw up. But tax planning I think can be really interesting and delightful for folks when they get money back, when they say, hey, taxes, I know I have to pay them, but man, I don't have to pay as much. And I kind of want to start with the difference between tax planning, which is what I think is great, and then tax preparation,
tax planning is really in our wheelhouse. That's what we spend a lot of time trying to figure out what a client can do. What are the different things that he can add to their life, right? Mm-hmm. And then we sit down and work with the preparation.
Yeah, the tax preparation is usually done by someone's CPA or enrolled agent or tax preparer. They're the one who puts pen to paper and says, based on this year's current laws, here's what we want to fill out your taxes for. Tax planning is usually a much larger view of saying, what are you going to do this year and next year, the third year and the fifth year, in order to make this really pay your appropriate taxes, but not overpay. So a good example I think that we can start with is tax preparation. So people are right now, they're in tax season, they're going through their own taxes. There's an article that we've read and I think is really useful, is saying, should a married couple file as jointly married? That's how most of them do it.
Which is most common.
Yeah, that's very common. Or to file married filing separately.
Which is not the norm.
It's not the and this, just to preface the beginning, this is not a choice that we would make for a client. We would raise the issue and we talk through it, but it's really the tax preparer for this year who would, in essence, prepare two returns, compare them and see which one's actually going to be better and help advise the client to make that filing choice.
Well, we have to be as aware of the circumstances so that we can say, this might be something that you might want to consider this year, but we need to bring in the CPA to get a second opinion on that.
And the example they use in this article of when this comes up is there was someone who both spouses were working, had good incomes, but one spouse had significant debt. But they were the key. It was education debt, and the key was he was on a government program that said if you work for a government agency for, I think it was 10 years, a number of years, you'll pay out a percentage of your income, and then after you've done that for a number of years, the rest of your loans are forgiven. So it's one of these good government programs for loan forgiveness, and he was in that. Well, they realized if they filed jointly, then the program would consider both of their income.
Right.
And so it was a much larger payment amount. Whereas if they filed married but separately, then the program would only look at his income and assess his payments based on his income and then would forgive it. So for them, there was a benefit of doing that. The other side is you lose a number of benefits when you're married, even just the tax brackets. If you're filing separately, you're in much quickly elevating tax bracket.
Yeah, I've had, divorce couples. People that are heading towards divorce, but they're still married. So they want to file separately. We've had some serious conversation with clients saying, this is going to hurt you if you file separately. It may be better for you to file jointly, but sometimes it just doesn't, they can't agree.
Yeah, and there's even some liability issues. If you're filing jointly, you're responsible for what your partner is filing and what they're asserting to the IRS. And so there's been similar in a divorce situation to say, I just don't know that I want to be tied to that.
I don't trust my spouse.
Yeah, right. And that's probably the whole reason for the divorce, right?
Right.
But we're in the process of separating and I want my financial situation to be separate. So that's one item, and that's just, I think, a good example of as financial advisors, we would talk to clients about this type of thing, but we're not going to be the ones preparing the return. We're not going to be the ones making that final choice. It's simply something to bring up with their CPA. But similar to that, there's things that we talk about of, what electric vehicle discounts are available this year, or what is the standard deduction this year. We know those and we talk about those, but ultimately that's something that we want to push our clients towards their CPA. There's some CPAs that we work with weekly that we're doing this, on behalf of the client, that we're the ones interfacing with their tax preparer. But those rules change kind of every year, and they need to be filed in such a way. So the more fun, I think, is the bigger view, is to say, let's do some tax planning. And probably the biggest one that most people can relate to is a retirement account.
Right.
So say if your work offers you a 401k or some sort of a other plan, the planning is, how much do I put in today and avoid the taxes? And I say avoid, I really mean defer the taxes. I don't get taxed on what I put into my 401k today. But then I come back 30 years from now when I retire and that money has grown, it's developed,
Yeah,
and
and
now it's taxable. So you've shifted it.
Right. And there's different kinds of plans. Like, for example, a 401k, you can't just write a check at the end of the year and put your money into a 401k to do a catch up. You have to do it on payroll deduction. So you want to work with the client and make sure that they are putting in the maximum they can contribute.
Yeah.
For sure, if a company is doing a match, you want to make sure that they're putting enough money to get the match. But also, if they cross a certain age, they can increase their contribution amount. So a lot of times people are just not aware of that. And payroll, the people in human resources aren't going to notify you and say, oh, by the way, you just crossed an age, you can increase your contributions by $7,000 a year or whatever it is.
Yeah.
They're not going to do that. But on those kinds of plans, 401ks, 403b, some of those, they can only be put in there by payroll deduction. Whereas other kinds of plans, for example, SEP plans and solo 401ks, you can wait. In fact, you set up the plan and you don't contribute to it until next year.
Yeah.
But it still counts for the year back. So there's different kinds of structures, right?
And it depends, for us, it depends greatly on the client. And for people listening, it depends on if you own a business,
Right.
you have a lot of options of what you can do. And some are good, some are bad, but you have options. If you're working for an employer and you get like a W-2, your options are usually what they provided you, whatever the company has set up, but you have within your own structure. So the planning, the idea would be, say you're making, $100,000 now, and you want to have $500,000 or $500 different that you could do something with. If you just took it as regular income, you would be taxed on it on top of that the $100,000 you're already making. So it gets taxed fairly high. If you put it into your retirement, let it go for 30 years, so ignore the money. But then after you've retired, your income has now gone to zero, say you're not making anything. Well, now to take that same $500 out, the taxes are very minimal. So you've deferred the taxes into a season in which you have a much lower tax bracket. And that is, in my mind, the essence of tax planning. You're appropriately paying everything you owe. However, you've elected to move some of that income into a period when it's nicer to have it. So that in my mind, that's kind of the quintessential aspect.
I think some little catches, for example, some things that have happened. 70 and a half used to be the year that you could take your required minimum distribution. They've now moved that up to 73 and even up to 75, but they've left 70 as the age in which you can make a charitable contribution from your IRA and have it deducted. So there's some differences and some nuances that you have to be aware of what you can do, where it has more, the impact, where it's not, right?
Yeah. And I think the interesting part of this whole industry, me shifting from law a number of years ago into now doing financial advising, there's a lot that people don't know, and they don't know. And when you Google it, you don't just find out what you're looking for. You get this tidal wave of stuff that may not apply. But for someone who is, in your example, charitably minded, they want to give, they've realized that their assets are more than they need.
Right.
They're going to make it through retirement. They have excess. They can give generously, and they've reached the age 70. It's like, I want to give some money. Often our clients think first, I'm going to reach into my cash, my wallet, and I'm going to give. And that's probably like number 4 on how you should be giving at that point.
Right.
There are better options, and the one you mentioned is if you can take a distribution from your retirement, which will lower your RMDs in the future. You can have it bring down your income if you're at RMD age, and you can give it directly. And that's a great way to give. Another way is appreciated stock. If you had appreciated stock, it's much more efficient to give that appreciated stock and get the fair value.
Or even real estate. Anything that has anything has a capital appreciation that you've held for a long time. And this is kind of estate planning, but you made a comment earlier. We were talking. You don't want to have deathbed giving.
Oh, it's the worst.
It is the worst, right?
Of stocks, or a house would be the biggest one. I have this rental property. I've owned it for 30 years. I'm late in life. I'm kind of on my deathbed. I want to give it to my daughter. Let me just sign a deed. And well, in doing that, you give them your tax basis. So if you bought it 30 years ago, you have all this capital gain tax that you might have to pay if you ever sell it. If you gift it during your life, they take on all that. You just gave it to them. Whereas that same deathbed situation, if you simply make a trust and have it go to that same person through your estate, and you pass away at your death, you get a step up in basis, meaning that cost basis you had that was so low goes all the way up to the current fair market value, and all those potential taxes, had you sold it, they disappear. And so your loved one who is now inheriting this property, they get it free of any built up capital gain taxes. It's a massive change, even though it may have only been a couple of days, say, deathbed versus a few days later. it's massively different in your taxes. And that's the type of stuff that we get excited about of, me with my background being an attorney, we can do the estate planning to say, okay, how do you want these assets to get to the next generation? And then in your life, while you're still alive, how do we want to plan out your own estate and your own income stream to make sure that you're doing this efficiently? So, I get excited.
I mean, we're bouncing around talking about different aspects of tax planning. And I think what really becomes the weight here is there is no simple, easy way, particularly for people in business or investors, people that have accumulated some wealth or have complexity in their life that is more than just straightforward.
Yeah.
And there's just a lot of avenues and there's a lot of decisions to be made. What is the best and how that all works out for you?
Yeah.
Right?
And there's some tax preparers that I really enjoy working with, that they are thoughtful and proactive at saying, this is what we're going to do next year, or this is what we're going to do 2 years from now. I would say a lot of them, though, part of the number of returns they're having to file each year, they're being reactionary to what happened this year, what the current law says, what you did. And we have clients that they just are so frustrated at times when they say, wow, okay, this is what you did. Hey, you could have done this before the end of the year, but you didn't.
But after the fact.
And then they are sad about it. So we'll take a break in a moment and go to our next section where we'll talk through some of these just key items. But I think your point is really well said, that this tax stuff isn't something you want to go alone. It's something you want some advice on, and to know, okay, here's my goals, here's where I'm headed. Let's do a multi-year structured plan that gets me tax efficiently to what I want to get to. And these tax laws, they change every year. We're constantly trying to stay up on this stuff. And
it's a dynamic of education that moves constantly. And you got to be careful what the big gorilla on the horizon is doing, because they're the ones that can hurt you. I'm talking about the IRS, by the way.
Right. The IRS, who just hired so many more agents that hopefully will get through backlogs and be efficient what they're doing. But you're right. I mean, no one often appreciates an audit. But if you've followed and done things appropriately, I mean, it
shouldn't be a fearful thing.
You're right. It's a process, not a fearful thing. So we're going to take a break. We'll come back in a few minutes. Stay tuned.